Hello there and welcome to another casual valuation. This time it's Levi's, and I'm sure that many of you are familiar with this company. Many of you are familiar with the products that they're selling. Well, in this video, we're going to take a look at the fundamentals to understand how they're making money so that we can lay down some assumptions about the future and value it as a whole. Now, if we take a look at the share price, we'll notice that the maximum amount of data available goes back only to March of 2019. And the main reason for that is when the company went public. Not for the first time, it has been public before, it has been taken private, and now it is public again. And of course, this dip here is because of the pandemic. We have seen it in plenty of stock price charts. But Levi's has been around since the 1850s. That's over 170 years, and it's been through a lot. I mean, the pandemic is, of course, a terrible event, but it has been through world wars, it has been through all kinds of different conflicts, all kinds of different scandals. So it's fair to say that the brand has gone through a lot. Now, let's take a look at what is Levi's. It is one of the world's largest brand name companies that designs, markets, and sells apparel. And it's important to note the activities that they're undertaking. So designing, marketing, and selling. Manufacturing is not mentioned there. They do a little bit of it, but majority or nearly all of the products are sourced and distributed through independent contract manufacturers. And of course, there are pros and cons whether it should be done in-house or outsourced. We're not going to go into the details of that right now. It's worth mentioning that all of the brands that are mentioned on the left side are owned by Levi's. Some originate from the company while others have been acquired. So they're not afraid to go after a company and acquire it if they believe it's a right fit within their product portfolio. Now, if you have read any of their reports in the last years or any of their investor presentations, or if you've seen an interview with their CEO, then you'll notice that these three letters D2C come up a lot. They're really focused on D2C expansion. So what is D2C and why is this so important? Well, D2C stands for direct to consumer, and it is important because let's try to do it in a bit more practical way. Let's imagine that we are a customer of Levi's and we want to buy one of their jeans. Well, if we buy them through e-commerce or through one of their stores or through a third-party store, it doesn't make a big difference to us because we would be paying a certain price and we would get our pair of jeans and that's it. However, for Levi's, it's different because if they sell the same product directly to us, then they get the cash. But if they sell it through a third-party retailer, well, that third party will get a small fee, right? Otherwise, why would they be even selling Levi's products? So the margins would not be the same if the products are sold direct to consumers or through a third party. And they have been working on improving this over time. 2011, only 20% of the revenue were sold, or 20% of the revenue came from products being sold direct to consumers. That increased to roughly 40% in 2021, and they're aiming for 60% by 2030. So they want to really focus on having this relationship direct to consumers instead of going through a third party. So we should be expecting improvement in gross margins, right? Now, this is how the historical financial performance looks like. And we're going to start with the revenues and gross profits, and we're going to move on to the other part of the income statement as we go along. First of all, revenues grew from a little bit below 5 billion to 6.2, 6.3 billion for the last 12 months, roughly 5% annual revenue growth. And the management is forecasting 9 to 10 billion in 2027. So as of today, that is kind of growing at 8% year over year, way faster than they proved that they can grow in the last 5 years. Now, of course, only because the management has high targets and high aims doesn't mean that we should implement those high expectations into our forecasts. As we all know, a lot of the expectations for public companies are really taken serious, and the moment that there's a little bit of a slip, you'll notice all of these headlines in the newspapers. This company didn't meet the targets or underperformed. And I mean, I don't want to look at the company that way. I want to be more conservative. So if I project a little bit less than 8% and they deliver that, then I'm still okay, because I'm kind of adjusting for that in an unfortunate scenario. Now, the gross profit, and in my opinion, this is a great indicator whether a company has a good brand. Especially now when there's higher inflation, the cost of goods will be higher, especially in the case of Levi as they're outsourcing, which means they would be, if they want to remain at the same level when it comes to gross profits as a margin, they need to increase the prices of their products. And they have been pulling that successfully so far. Not only that, their margins have even improved in the last 5-6 years from somewhere around 52% to 58%. So 6% increase. I think that's a job well done. I mean, not many companies can do that, especially not many companies that are in this stage close to maturity. So we have improvement of gross margins, and if we take a look at the other operating expenses, there it actually goes the other way. We don't have any improvement. If anything, it got a bit worse, as all of these other expenses, mainly being sales, general, and administrative, and that is one bucket where all of the operating expenses are reported by Levi. So we're looking also at marketing, pretty much everything that you can imagine, except for the cost of goods sold. It increased from 40 to 43, 40, kind of 44, 45%. So we have improvement of the gross margin, but we have a more significant increase in the other expenses as part of the revenue. Now, if we put all of these together, of course, we will get something that looks like this. You'll notice that the operating profit, so taking all of the expenses, improved, right? So we have improvement of gross margin and a worsening of the margin for the other expenses, but it managed to increase from 10 to 12%, so 2% improvement, except for 2020, that is the year with the pandemic. But even then, they didn't perform that bad. They weren't really losing a lot of money, so that's actually good to see that they had a drop of somewhere around 20% of the revenue, but still, it's quite expected in that environment. Now, the management is expecting that this margin improves to 15%. And we know that kind of 2% of that would come from the improvement of gross profit. So then there's kind of 1% more that they expect to come from reduction of other expenses as percentage of the revenue. Now, let's take a look at the balance sheet before we move into laying down any assumptions. First of all, if we go from left to right, we won't see that huge of a difference when it comes to any line except for the inventory. And that is something that, of course, it's important for them as a company, but we cannot make a judgment only based on one data point. We need to figure out what the hell is happening here, because the level of inventories has been pretty stable, 800 to 900 million, and now we have 1.1 billion. Now, one thing that causes that is, of course, inflation, higher costs. They get translated into higher costs of goods. The other one is increased price of cotton. That is one of the materials that is being used, although it is coming down a little bit now. But it could be that they're just buying a lot more inventory that they're not selling. Just buying more inventory allows them to negotiate lower prices per product, which would increase the margins that they have. But if they're not able to sell them, then that's also a problem, because that's pretty much tight capital there. So that is something that we need to pay attention in the coming quarters, especially, of course, those that are investors in the company. From a cash point of view, they have managed to be in a very good cash position. Even in 2020, we have an increase, and we'll see that on the other slide. They have an increase because, of course, there's a lot of uncertainty with the pandemic, and they wanted to make sure that they have enough liquidity to be ready for whatever happens or for however long it takes to recover. They're aiming to pay out 25 to 30% of their profits, so kind of a dividend payout ratio is at roughly a third, and with the remaining part, they can decide what to do. They can decide to use part of the authorization for share buybacks, 750 million, or they can acquire another company. I mean, that's also something that they have done. I mean, if you take a look at the goodwill, that also suggests that they've done a couple of acquisitions in the last years. And if we take a look at the liabilities and equity, we'll see this slight increase in long-term debt. Well, maybe not that slight, 500 million, but it's gone the year after that. And This is a temporary increase again due to the pandemic. They were not sure what will happen. So better to be safe than sorry. They got a good kind of adapt at a good rate. And after that, they saw that, okay, we don't really need this, so we can pay it back. But apart from that, there isn't really anything that looks strange or weird. I think they're in a good financial position for the future. So I think we can really take at the next step and really take a look at what the hell are the analysts expecting from this company. And I was a bit surprised because the difference between the analysts with the low estimates and high estimates wasn't that wide. I mean, normally, and if you've seen other videos, you'll notice that by companies that are a bit more risky with a lot more uncertainty, this gap is much higher. But in the case of Levi's, it's not that wide. Not only for 2022, but 2023 as well. They're kind of forecasting not the 8% year over year, kind of 6% more pessimistic assumptions on average. What is interesting is that the operating margin, although is improving, it's not, of course, at the level of 15% as the management is aiming for 2027. So there is an increase, but it's not that steep of an increase. It's kind of a slow increase. And every time that I want to that I'm laying down assumptions, the first thing I want to understand is what has the management and the company proven that they're capable of. In the case of Levi's, they've proven that 5% revenue growth is possible. They have delivered that for years despite the pandemic. But 8%, it's great to have that as a target. It could be great for the shareholders, but I haven't proven it yet. And we also see that the analysts are a bit skeptical at this stage. So my expectations are 5% revenue growth. And if I buy Levi's based on these assumptions and they deliver 6, 7, 8%, perfect. But if I forecast 8% and they deliver 5 or 6, then you'll see Levi's in all of the newspapers and one of the headlines that they underperformed. Same goes for the operating margin. They're close to 11.5%, 12%. I'm expecting them to improve it by 12.5%. And I think that's possible. Again, taking into account the improvement that they have done direct to consumers. And also, I do believe that they have a lot of expenses that they can still cut. They're growing, but the expenses should not be growing faster than the revenue. So I think that there's improvement there. But I'm not going to forecast the 15%. 12.5%, that's as high as I can go, and that's what I'm comfortable with. So we're going to forecast the cash flow based on these assumptions, and we're going to discount them with the weighted average cost of capital of 7.7 to 8%. So the outcome looks something like this. With my assumptions for the revenue will grow about 53% in the next 10 years. So 10 years from now, it will be 9.5 billion. Again, let's not forget, that's what the management is aiming for in 2027. So I'm a lot more pessimistic. And of course, the margin is much lower, but they need to do some additional reinvestments, whether that is in acquiring a new company. Maybe that's how they intend to boost the revenue, or whether that's in increasing inventory for whatever reason that may be. So based on my assumptions, the free cash flow, 440 million next year to kind of 800 million in 10 years from now. And the summary looks like this. The terminal value, or the value of the company 10 years from now, 11.5 billion. We discount that to today, 5.4 billion. And if we combine that with all of the cash that the company will generate, free cash, in the next 10 years, the present value, 4 billion, we get to the value of the business being close to 9.4 billion. Of course, they have cash and they have some deferred tax positions that we need to take into account that will reduce their future tax payments. And we have to subtract the debt and equity options. When we do that, the fair value of the company based on my assumptions is somewhere around a bit below 8 billion. Or per share, roughly $20 a share, a little bit higher than where it's currently trading at. But I could be significantly wrong with my assumptions, right? So what I have on the next slide is the valuation per share based on different assumptions. So the second row, revenue growth of 53% in the next 10 years, that is based on my assumptions, and 12.5%. Again, that's kind of close to where they're at the moment. The row below, 86%, that is based on where the management is, or what the management is aiming for. So 86% revenue in 10 years. And on top of that, they're aiming for 15% operating margin. If they're able to deliver that, then we're looking at fair value today of around $28 a share, kind of 40% higher than where the share price is today. If they did deliver on one, so hypothetically, if they grow to 11.6 billion, but the margin remains kind of the same, then the fair value is around $23 a share. If on the other side, they deliver on the margin, but not on the revenue growth, 24. So in both cases, there's kind of a 20% upside compared to where the share price is today. Now, in my opinion, this is a company that is not that risky, at least at the price where it is today. And it's interesting that in the investor presentation, the management is aiming for 10% return for the shareholders. Part of that in dividend, it's about 2% dividend yield, so not that 2-3% dividend yield, so not that high. Partly through the share buybacks, and of course, a high portion of the 10% return that they're expecting is through improvement of the fundamentals, through revenue growth, and through improvement of the operating margin. That will be all regarding this video. I'm definitely going to considering opening a position at this price, and especially if it goes below, then I'm definitely going to open a position. If we take a look at where the share price was, let's go back to the first slide. You'll notice that there was a time that it was like at 17, 18, not that far ago, not that long ago, and it was at 9, 10 at the pandemic. I mean, looking back, of course, it looks obvious that a company that has been around for 170 years is very likely to survive a pandemic, especially if we take into account what it has all survived. But it is something that we can take into account, and I will definitely be investing in it if the share price continues declining, as it has in the last year and a half or so. But that would be all regarding this video. If you have any questions or comments, please let me know in the comment section below. And as always, I'll see you in the next one.